All right. Welcome back to Two Stupid Guys Trade Stocks. I'm Vinny.
I'm Dylan. Today we're going to talk about the possibility of joining Mr. Burry on one of his bets from his Q1 filing because a new opportunity has presented itself, ladies and gentlemen.
Love it. So if you guys enjoy entertaining stock market content, please consider giving us a like and subscribe below. We'd love to have you here. It's funny. I brought the old wallpaper back out here in case you didn't notice there, Dylan.
I did.
Talking about inflation, how we'll be papering our walls with the U.S. dollar again sometime soon. That's what this kind of bet is on a little bit.
Sort of, a little bit.
A little bit. Get to it here. Essentially, the thing you have to really understand is that bond prices and yields are kind of opposite sides of the coin. The way bonds are priced is it's a current price of $100 in the future, and the difference there between what you pay today for that $100 in the future is how the yield is determined. If we'll make it simple. If it was a 1-year bond, $100 in a year from now, and you sold it to me for $80, that'd be a 20% yield. I know, crazy huge number, but just to give you an idea, and when we're talking about longer term bonds, it becomes a little more complicated because you have multiple years, you stretch that out over. But the point is that yield and price are opposite sides.
Right. And that's the biggest thing to grasp. We have a whole video on his whole bet. We won't repeat that stuff, but for the rest of the video, just yield, price are opposite. That's all that matters.
Exactly. And the reason why we're making this video is we've been given this great opportunity to potentially re-enter these trades. Just to kind of remind you of what the positions were, we have a separate video on all the the Burry inflation trade, but these are the positions that he has contained within his 13F quarterly filing for the first quarter of 2021, and these are the positions that he used. It's a little complicated. It's I'm not going to lie. He's using options and he's using ETFs and multiple inverse ETFs that are levered. So it's not a straightforward bet. But the basic premise here is that at some point the Federal Reserve is going to stop buying U.S. Treasuries like hand over fist, and the market's going to be allowed to return to normal market forces. And as a result of that, you're going to see the yields increase and prices drop. So a bearish bet against the price of bonds, longer term U.S. Treasuries, is the play at core here.
To make this simple, because Vinny has been explaining this to me for 20 minutes and I still don't really understand. These are very complicated bets in very weird ways. All that matters, if bond prices go down, these tickers make money.
Exactly.
That's all I know. That's all I get. Bonds are very confusing.
Except for TLT, you have to buy a put contract on that. So
Right? Yeah. Hold on. Oh, I hope it didn't mess anything up. Yeah. Put on TLT. It's in parentheses.
Yeah. Exactly. These three would all profit by the price of bonds dropping.
Got it.
All right. So
all right. Do you know Dumb and Dumber?
Yeah, I do. This is a great scene. Classic.
This is a fantastic scene, and this is the only way I can understand bonds.
You might want to save that one.
Yeah, I did. But it's an IOU between the lender and the borrower that has a fixed price and interest rate. And the bonds are used by companies, governments to finance projects, whatever. But owners of the bonds are debt holders or creditors of the issuer. I just remember he opens up the briefcase and he just grabs this one. He's like, 875,000. That's a big one. You're going to want to hold on to this.
Yeah, exactly. That was for the Lamborghini, right?
Yeah.
I love it. All right. So, how does this whole thing affect inflation, right? Like that's your question. As we're starting to see inflation, like I don't care, like, the indicators are certainly showing it, but you're seeing it in your everyday life too. I don't know have you personally had an interaction with inflation recently, Dylan? You've noticed?
Yeah. Building materials for fixing houses.
Yeah. Absolutely insane.
A nightmare.
Yeah. And I was telling Dylan, I keep talking about this. There's like a grill I was like following for a while, and it went from like $800 to like $1,300 right now. I mean, and it's still sold out, and their quality control has gone downhill.
Yeah, I bet.
Yeah, it's absolutely insane. But the whole idea is that as they're pumping more and more cash into the economy, the prices are going to continue going up because you have more and more available currency competing for a fixed amount of goods, right?
That's a really good way of. You should make me a plaque that says that, because this stuff is so confusing to me.
I'm still learning. I'm no economist here, but this is what we're always looking at.
Yeah. So over the next couple of slides, this is just the Treasury yield in a more macro view. This is 20 years. Okay. So hovering around 5%, goes all the way down to like 0.6% during COVID, goes up to 1.6, like 3, and now we're chilling around 1.3. So that's the whole macro view of 20 years. So let's just look at 5 years to get a closer up view. So this is 5 years. As you can see, you still see that big dip, and we're coming in. And then the next slide. So due to Burry's 13F quarter one filings, we don't know when he bought. We just know that during either January, February, or March, he bought these bets that he was doing. So that's what's in that box there. And you can see that it was actually really bad on Friday. I think what is it, Friday, like 1.25, or Thursday was like 1.
Thursday was the low. Yeah, it was down.
Yeah, that everyone was wondering what that big kind of, not big correction, very small correction. Everyone freaked out over a 1% drop in the SPY.
Yeah.
But that's what's happening. So basically what we're saying is he bet that would go up. I highly doubt it was on January 4th. That would be perfection, although it is Burry.
You never know. Yeah.
Average the 1.2 range. Okay. And we are at that, very close to it right now.
Exactly. Yeah. I don't know if you want to look at the more specific chart of one of the plays here.
Yeah. So assuming right here is the earliest he could have bought and then the latest he could have bought. So we have this big increase, right? So what we're saying is this opportunity is presenting itself again, because we have now come downhill since then, and we are chilling all the way down here. Don't worry about these EMAs. This doesn't really matter for this kind of stock, or SMAs, not EMAs. So you can see that we have a whole nother opportunity to mimic his bet that he likely took in this range, using, probably a little bit lower, but likely took in this range.
Yeah, and kind of at this point, the Federal Reserve still has not discussed a date for when they're going to start to curb purchases, or definitively said that this is going to happen or begun to do so. So there's still many catalysts that could occur over the next 12 months or so that would make this a very profitable trade.
Yeah, we don't really have a timeline, but logically, I'm not going to call a time, but I would think within the next year we got to, we can't keep doing this.
Yeah, it makes perfect sense. Kind of like where, I don't know if you've seen actually this graph here. So this is interesting. This is looking at the kind of balance sheet of the Federal Reserve from the Peterson Foundation. So Peter Peterson there was actually a former chair of the New York Federal Reserve, and he's since passed away. But his foundation has kind of continued the work of looking at financial instruments and explaining them to the public. But we saw obviously this huge spike here. But if you can look at the graph here, it continued to expand after the COVID spike. It's still going up significantly. What does this represent, right? This is notes and bonds. This is long-term U.S. Treasuries that are being purchased by the Federal Reserve, right? They're talking about a total balance sheet now of $4.5 trillion. Right? It'd be nice to have that kind of checking account, huh?
Yeah, that's a lot of money.
And I took this from their the Federal Reserve website. They're still continuing the purchases of $80 billion a month. This is what this whole thing is based on, is the fact that the market is not allowed to free float right now. There you have this gorilla, this Federal Reserve out there in the marketplace spending $80 billion a month with no actual thought or consideration for the underlying value. They have $80 billion to spend, they spend it. It does not matter the fact that they have pushed the prices to a unreasonable point. This isn't a normal market. This is a false market where it's not able to adjust itself. And at some point, when they ease off of this, the market's going to adjust, and it's going to adjust violently, probably. And
right. And when the market adjusts violently, Treasury yield should increase
Exactly.
at that time. Hence the bet.
Yeah, this is what you're looking at, the Federal Reserve here. You know, I was thinking of this. I took a film class in college, and I don't know if you ever looked at film, Dylan, but like you notice the angle that this is shot at. It's kind of a low angle, designed to make the building look more powerful and you know, like controlling.
I would not have. Yes, that makes sense.
Yeah, I mean it's true. I mean the building itself with these giant columns is very imposing, but you know that
looks like something out of Russia.
Yeah, well, I mean, it's, you know, this is America, and this is kind of made me think of this quote. I know it's the exact phrasing is kind of contended, but it's you know, give me control of a nation's money supply, and I care not who makes the laws. That's the idea. This is Mayor Rothschild. You've ever heard of the Rothschilds?
Little bit.
Yeah. He's the guy that kind of started the dynasty. He died in 1812.
He had a big oil monopoly, right?
No, you're thinking of Rockefeller.
I am thinking of Rockefeller.
Rothschilds are banking. That was kind of their background. European banks. They was like the actual bank for Germany. I want to say at one point in time. Basically, he was like involved in like their finances heavily. During like World War One. I'm sorry, no, before then, but World War One was a big time for them. Yeah, very interesting. So this is, you want to take us through your thesis here? Yeah.
So this is just echoing a quick summary of everything we just said. The government cannot continue to pour money into bonds at the current rate. It's the risk of hyperinflation becomes more and more real. We're already seeing it. If anyone is trying to build a deck right now, you know exactly how that feels, Vinny. Yeah, therefore, at some point, the government has to decrease the bond buying, which in turn increases Treasury yields. So this isn't so much, whenever you invest in a stock, you're doing your research, you're hoping that, you know, everything you're looking at is real. But I don't know, the CEO could like do cocaine and then the whole stock goes down. This is more of a logical play. We don't know when it's going to happen, but we know that it has to happen at some point. Looking at the TLT, I like to look things at a short way. So I like this one a lot. Wait, is this one of the short ones? It is. This is a put. I was looking at put options. If you look at some of the prices that were there, it's not too expensive even if you go 2 years out. 2 years out, putting down like $2,000, you can buy like 8 put options on this. That will probably return a pretty solid amount if you pick the correct strike price.
Yeah, that's pretty awesome. I mean, because, you know, it's eventuality. I think it's just a question of timing.
Yeah, which is why the 2-year fluffy window.
Yeah, that is a nice fluffy window. I would agree.
Yeah, it's not too expensive.
Yeah. All right, guys. Well, thanks for tuning in. We'll catch you guys in the next one. Let us know what you're thinking down below.
Have a good one.